Good morning. Whether you're filling up your car, heating your home, or just buying groceries, the price of oil touches your life in more ways than you might realize. Today, we're diving into something that affects all of us: oil prices. They're not just numbers on a screen, they ripple through the entire economy, shaping what we pay at the pump and even the cost of everyday goods. This week, oil prices have been on a wild ride, up on Monday, down by Tuesday, and then back up again. It's a pattern that's become all too familiar for anyone watching the markets. Brent crude slipped to around $63 a barrel, and WTI dropped to about $58.50. These numbers might seem small, but they can have a big impact on global markets and your wallet. These seemingly minor shifts actually reveal a much bigger story: a constant tug-of-war in the oil market, with powerful forces pulling prices in opposite directions. On one side, there are fears of too much oil flooding the market, which pushes prices down. When supply outpaces demand, prices can tumble quickly. On the other side, global tensions, especially the ongoing war in Ukraine, create uncertainty and push prices up. Geopolitical risks can send shockwaves through the market in an instant. It's a daily battle. One day, traders worry about oversupply. The next, they fear sudden supply disruptions. The mood can shift in a matter of hours, keeping everyone on edge. This constant push and pull creates volatility, making it tough for businesses and consumers to plan ahead. For families and small businesses, even small price swings can mean big changes in monthly budgets. Headlines swing between predictions of lower gas prices and warnings of sudden spikes. The uncertainty keeps everyone guessing, from Wall Street analysts to everyday drivers. Understanding these two main drivers, oversupply fears and geopolitical risks, is key to making sense of the price changes you see at the pump. It's not just about economics, it's about world events and market psychology. It's a complex dance between economic forecasts, political developments, and real-world events. Every headline, every policy change, and every conflict can tip the balance. Every day, the market reacts to whichever force seems stronger at that moment. Traders, analysts, and even governments are constantly adjusting their expectations. And that's why oil prices rarely stand still. They're always in motion, shaped by a world that never stops changing. Let's dive into the biggest factor pushing oil prices down: oversupply. In recent years, oil production has ramped up across the globe, with countries and companies racing to extract as much as possible. This surge has led to a situation where there's simply more oil than the world currently needs. Experts predict that by 2026, the world will be producing much more oil than it needs. This isn't just a short-term blip. Many analysts believe the oversupply could last for years, especially as new oil fields come online, and existing ones keep pumping at high rates. When supply outpaces demand, prices drop. Basic economics. The more oil that floods the market, the less each barrel is worth. This dynamic is already playing out in real time, with prices reacting to every new report of increased production. Priyanka Sachdeva, a senior analyst, says the key risk right now is oversupply, making current prices vulnerable. She points out that even small increases in output can tip the balance, sending prices tumbling. Many in the industry share this bearish outlook, expecting prices to fall further if the surplus materializes. Oil executives and traders are bracing for a prolonged period of uncertainty, with some already cutting back on spending and new projects. Oil-producing countries and companies are worried. Their profits depend on higher prices. For nations whose economies rely on oil exports, a prolonged slump could mean budget cuts and economic pain. Heavy investments in new capacity could backfire if there aren't enough buyers. Companies that bet big on future demand may find themselves with stranded assets and mounting losses. While consumers might welcome cheaper gas, the industry faces tough times ahead. Lower prices mean layoffs, reduced investment, and ripple effects throughout the global economy. The expectation of surplus is already influencing today's prices. Markets are forward-looking, and traders are quick to react to any hint of oversupply. Traders are acting now based on what they think will happen in a year or two. They're pricing in the risk of a glut, which means volatility is likely to continue. That's why oversupply fears are putting downward pressure on oil, even as other forces try to push prices up. The market is caught in a tug-of-war between supply and demand, with oversupply currently winning. The shadow of future surplus is chilling the market, leaving everyone from oil giants to everyday investors watching nervously for what comes next. Let's put numbers to this oversupply story. Deutsche Bank forecasts a crude oil surplus of at least 2 million barrels per day by 2026. That's like adding Brazil's entire daily output to the market with no extra demand. This isn't a short-term blip. It could be a fundamental shift, with supply outpacing demand for years. The surplus comes from major investments in production, just as demand growth slows, thanks to efficiency, electric vehicles, and renewables. More oil, less need for it. A recipe for a glut. A surplus this large can't be easily absorbed. Storage and small production cuts won't be enough. Coordinated cuts are tough to agree on, so the market is bracing for lower prices. That's why the forecast is already dragging prices down. The market is preparing for a future with too much oil. Now, let's look at the other side, the Russia-Ukraine conflict. Hopes for a peace deal and the lifting of sanctions on Russian oil have faded. As long as sanctions remain, a major producer is restricted, tightening supply and supporting higher prices. The conflict also risks disruptions to pipelines and ports, which could cause sudden price spikes. This geopolitical premium keeps oil prices from collapsing, even with oversupply fears. Traders pay more for oil as insurance against sudden shocks. So, while some focus on economic forecasts, others watch the news for supply risks. The war acts as a floor under prices, pulling them back up whenever they fall too far. Uncertainty from the conflict keeps the market on edge. Russian oil faces new hurdles, not just bans, but tighter sanctions on companies like Rosneft and Lukoil. Now, Europe blocks oil products refined from Russian crude, even if processed elsewhere. This hits countries like India, which bought discounted Russian oil, refined it, and sold products to Europe. With new rules, that business model is at risk. Indian refiners, like Reliance, are cutting back on Russian crude to keep selling to Europe. They must find new suppliers, while Russia seeks new buyers. This reshuffling disrupts global trade routes and adds complexity. Both sides scramble to adjust, creating inefficiencies and uncertainty. The ripple effect is global. A change in Europe forces shifts in India and Russia. These disruptions add another layer of unpredictability to oil prices. The market must adapt to new realities, often at a cost. Sanctions are reshaping the global energy map. With India buying less, Russia turns to China as a key customer. Moscow and Beijing are discussing expanded energy ties. If China buys more Russian oil, it will buy less from the Middle East or Africa, forcing those suppliers to find new buyers. This triggers a domino effect, realigning global oil flows. Logistical challenges, like tanker shortages and port congestion, add costs and volatility. The total oil supply may not change, but getting it to the right place becomes harder and pricier. Sanctions create friction, keeping prices from falling too fast. The global oil market is more interconnected and unpredictable than ever. Let's bring it home. U.S. interest rates matter for oil prices. The Federal Reserve sets rates that affect borrowing costs for homes, cars, and businesses. Rates have been high to fight inflation, but now there's talk of a cut at the next policy meeting. Lower rates would signal that inflation is easing and could boost the economy. Cheaper borrowing encourages spending and investment, which lifts demand for oil. The U.S. is the world's largest economy and a top oil consumer. Any move to stimulate growth here is seen as good news for oil prices. Even the expectation of a rate cut is already supporting the market. It's another bullish factor in the ongoing tug-of-war. Oil prices react quickly to any hint of economic change. How does a U.S. rate cut boost oil demand? Lower rates make loans cheaper, so people buy more cars, meaning more gasoline needed. Housing and construction pick up, both energy-intensive sectors. Businesses borrow more to expand, build, and transport goods, all requiring energy. This surge in economic activity drives up demand for oil, diesel, and jet fuel. Even the expectation of a rate cut can move markets. Traders bet on stronger demand, offsetting some oversupply fears. The result? Oil prices find support, even with a looming surplus. It's a delicate balance. Bullish demand signals versus bearish supply forecasts. The market is caught between these forces. Expectations can be as powerful as reality in shaping prices. That's why oil remains volatile. So, what does all this mean for you? Whether you drive every day or just fill up occasionally, the shifting oil market has a direct impact on your wallet and daily life. The oil market is being pulled in two directions: oversupply pushing prices down, and geopolitical risks plus economic stimulus holding them up. This push and pull creates a delicate balance, making it hard to predict where prices will go next. Expect continued volatility at the gas pump. Prices may bounce around rather than move steadily. One week you might see a drop, the next a sudden spike, all depending on global events and market reactions. The biggest factor to watch is the forecasted surplus for 2026, which could mean lower energy costs. If supply continues to outpace demand, you might benefit from cheaper fuel and lower heating bills in the future. But any escalation in Ukraine or new supply disruptions could send prices soaring. Political tensions and conflicts can quickly change the outlook, making the market even more unpredictable. U.S. economic policy is the third key. A rate cut could boost demand and nudge prices higher. Decisions made by the Federal Reserve ripple through the oil market, affecting everything from consumer spending to global trade. Good economic news might mean slightly higher prices at the pump. When people feel confident and spend more, demand for oil rises, and so do prices. Everything is interconnected. Jobs, spending, and energy use all feed into oil demand. The choices you and millions of others make every day, from commuting to shopping, shape the bigger picture. We're in a period of uncertainty, with no clear winner in the tug-of-war. The market is constantly reacting to new information, and that means surprises are always possible. Stay informed, watch oil forecasts, Ukraine developments, and Fed decisions. Being aware of these factors can help you anticipate changes and plan ahead. Understanding these forces helps you make sense of your energy bills. When you see prices rise or fall, you'll know what's driving those changes. The global oil market is complex, but knowing the drivers puts you ahead. By staying curious and informed, you can better navigate the ups and downs, and make smarter choices for your budget and lifestyle.